thanks everyone for dialing in. I think we've got just over 900 people registered for today's call, which is great. So thanks everyone for your interest in our analysis. So this webinar is looking at the ALTCE analysis of the NCREIF ODCE index up to the Q2 numbers. So over the next 50 minutes, Robbie Tangien, who heads up our ALTCE valuation advisory business globally, and myself, Phil Tiley, head up the performance analytics data division, will take you through those latest ODCE numbers. So just to qualify, the benchmarks are based now off 25 ODCE funds, so one having dropped out last quarter, but that's going to be in there historically. And then within ALTCE, we have an extensive valuation data set, which we then match up with the ODCE funds to provide added intel into the analysis using kind of key valuation metrics. The webinar is part market insight for our wider kind of ALTCE client network, and it's also a precursor to our client one-to-one conversations. So clients who are also NCREIF members, where we replicate this type of analysis on a comparative basis, and we obviously look forward to taking forward those discussions over the coming weeks. Before I kind of pass over to Robbie quickly, I just wanted to stress how this webinar is very much a collective effort. So a massive thanks on my behalf and Robbie's as well to everyone involved in pulling this information together. It's a mean feat. So that's the performance team that work alongside me, the wider advisory business unit who kind of review all of our client valuation data, obviously the support kind of marketing and events team, obviously our client base, and thanks to them for providing us with privileged access to their data, and then to NCREIF. Find the benchmark numbers. So we have a number of polling questions that we run through as we go through the presentation. So maybe over to you, Robbie, just to pick up on, well, the one that we finished off with last quarter. If I can move the slides on, just to see what people thought the returns might be thinking about this quarter.
Perfect. Yeah. So and before we start, just making sure people can put the question in the question chat box, right? So then we can address it either throughout this entire webinar or at the end of it, right? So yeah. So as always, as we start, we're going to look at the poll from last quarter, right? So can power of many predict the return this quarter, right? So last quarter we asked what is the total unleveraged property return to be in 2Q 2023, right? So it's negative 2.2% in 1Q 2023. So majority of them answers between -2 and +1, right? So and then a close second between -4 to -2. So that indicate to me is slightly better than -2. So Phil, is it pretty accurate?
So yeah, as you call it, the power of many, Robbie. They got it pretty bang on the button. So there it is, top right hand side there. That's the number for the quarter. That's coming out at -1.9% for the quarter. So just to clarify, and this is what we're going to be breaking down, we're focusing on, this is the kind of pure real estate part of the ODCE. So there's no leverage, there's no cash, no fees in this number. It's pure real estate. And as Robbie mentioned, these are total returns. So that's income and appreciation. So the market did continue its downward trajectory, in that it's posted its third successive negative rate of return, -1.9. The operating asset rate of return was a shade below the overall return. So into that top line, you're including the development properties, and a number of those will be valued at cost. And so technically in a declining market, that cost valuation may be propping up some of those performance levels. But the continued contraction returns that we're seeing here, I assume, will come of no surprise, as that polling question revealed, given the, I guess, ongoing uncertainty in the economic backdrop, the overall elevated cost of capital as the market braces itself for a potentially period of higher for longer interest rate environment, all of which as a collective is putting further downward pressure on the market. There wasn't actually a great deal of change between the now and the prior quarter, a fraction a little less negative in the last 3 months, 30 basis points better off, but that does mask more of a mixed set of results that are now playing out across the sectors. So in terms of the rank order of the sectors, we're color coding those in relation to whether they're north or south of the overall ODCE rate of return, and the outlier there, no surprise, are the offices, which remain firmly rooted to the bottom of the stack. They cast now even further adrift from the other sectors, returns dropping to minus 7.3%. Such is the kind of demise in the office sector and the pullback they've had on the overall Odyssey of the last quarter. It's actually the only sector to come in below the Odyssey return for the last 2 quarters. So what about the other sectors? Apartments, the pace of decline slowed from minus 2.3 to minus 1.2. Industrials have also been trending back up and actually regained their position as the top of the rankings. Returns there turned positive last quarter. Retail's lost a little bit of ground over the quarter, but they remain ahead of that kind of other grouping there at minus 0.6 there.
Bill, on the other category, I know that we asked that question. Is it mostly self-storage? What's included in the other category?
Yeah, good point to qualify that, Robbie, because we do get asked a lot, and it's a bit of a eclectic mix. So the majority is self-storage, so it's just around about 50%. There's also healthcare in there. We've seen that grow with the inclusion of SFR as well. We're also seeing some MOB and life science properties there. Most MOB and life science do fall into the office category, but some have that categorized under other. NCREIF is in the process of just getting all of that reclassified, so we're still kind of waiting around for that one. In terms of the returns, if you look into that minus 0.6, the storage was minus 0.2, so they're kind of more similar to retails. Healthcare, close to, I think, it's like minus 1.7, I made a note. SFR a little bit further adrift. So yeah, there's a difference returns within that, but storage is the major element still. In addition to the returns that we're posting there, something we started to report last webinar is the bottom set of numbers, and that's the spread of returns from top to bottom across the different sectors. So with offices dropping away now from the rest of the pack, and that familiar look with industrial starting to tick back to the top end of the rankings, we're starting to see more of this dispersion and returns open back up again, having that closed in when all sectors initially turned south at the back end of last year. There's still way less divergence playing out across the sectors when you compare that with these double-digit spreads in the back end of 21 and the early part of 22, when the industrials are simply racing ahead of themselves. But you know, that spread is now longer, now greater than the long run average.
So on the long run average, I know they're right now about 7.5, and then you look at 2021 seem pretty elevated. What is the long run average, Bill?
So I worked the long run average over the last 10 years to be just over 3%. So yeah, we're at 7.5% spread. We're definitely in excess of that. But I guess what it's worth noting is that offices aside, there's actually not a great deal of spread between the other sectors. That's actually less than a percentage point but between the rest. And actually that's illustrated better if you chart those returns. And it also illustrates on this next chart the fact that returns generally for the rest are moving in the right direction. And you can see they're pretty tightly bunched, with the exception of offices which are on a different return trajectory now to the other main sectors, which is not something that we typically see a great deal of. Sectors tend to move in sync with one another, as you can see here, but at different orders of magnitude. The other instance where we saw a bit of separation was that spate of repricing there that was targeting the retail sector just before COVID around 2019. Another way to assess the return level on this next slide is then to assess the impact that each sector has had on the overall Odyssey returns. So using weighted contribution analysis, it turns out how much does each sector contribute to the overall Odyssey return. So we're effectively kind of breaking down the numerator of the return for those that get into that level of detail, but we're then factoring return also with the weight that these sectors account for within the overall Odyssey. So on that kind of weighting part, let's just have a quick look on this next slide at the structural makeup of the Odyssey and how it's changed over time. I'm looking at this in terms of 3 different staging posts, and I think we've shown this before. So the right-hand side, that's now or end of Q2. Over here, the left-hand side, that's 10 years ago, and in the middle, that's the point just before the pandemic, so December 19. So it's a kind of disproportionate timescale at play here. But what's notable is there's not a great deal of change between here and here, But for a shorter time period, over 3.5 years, there's quite a notable change across the structure of these portfolios. So, offices and retails, the kind of purple and the green, they've gone from over 50% of fund weights to less than a third now. The retail allocation is pretty much, the purple has been cut in half. The offices have gone from 35 to just over 20%. They were at 40% 10 years ago nearly. And those reduced shares that have been picked up, or I guess caused by the growth, you call it, of the industrial sector, that's gone from 18% up to almost a third of portfolio values through the period of the pandemic. And you've also got the emergence of the alternative sector. So very much a different structural makeup of these funds than we have been seeing if you take it back historically.
So if you look at this chart, the decline in office and the increase of industrial, right? So is it mostly to the value change, or is it the acquisition/disposition?
Yes, that's a good point, and actually something we haven't actually run the precise numbers around. I mean, we did. I think we did some running around this a couple of quarters back, and so I don't have the data for this quarter, or going up to this quarter, but I think some of the shifts, yes, will be down to investment trends, but I think when we worked it out previously, certainly the largest aspect of the structural change is down to the performance levels that are playing out across the different sectors. But yeah, we should most probably run that more precisely. But I guess, Robbie, when you think of those weights in relation to this chart, what's interesting is then to think of how the Odyssey kind of performance is made up across those sectors. The dashed line is the Odyssey, then the color contributions come from the individual sectors.
Yeah, I mean, kind of interesting, right? You look at this chart, the green bar, the office, was kind of close to 50%, like in 2013 to 2015 range, right? So, and it kind of showed that how important the office sector to Odyssey is 10 years back. And now when on the pandemic period, basically 2021, 2022 is pretty minimal right now in a negative way, right? So in the last 3 quarters. So it's definitely an interesting trend here.
Yeah, and to that point, when you go back 10 years ago, I mean, think of those weighting charts. I mean, offices were accounting 40% of value, and actually just jump back to this slide. I mean, the returns were pretty tightly clustered back then, so that kind of value weight was definitely coming through there. Their impact really started to diminish at the time at which industrial started to really emerge as a growth sector. And then what's really notable is just how much of the Odyssey return industrials then accounted for during, let's call it, that kind of post-pandemic growth spurt, with a bit of backup from the blue, the multifamily. I mean, retails and offices were still positive contributors during this time period. So the way to kind of think of the results here is that if the Odyssey was just the retail and the offices, the return would still have been positive, but it's way more positive during this period because of the inclusion of the industrials and the growth there, the multifamily. Others were obviously another lead sector there, but their impact is less so because just the weight that they carry within the overall index. And to your point, in terms of the pandemic and the initial kind of correction there, this kind of this really jumped out for me just in terms of how retailers bore the brunt of that decline during the initial onset. And then think more recently here, when the market started to correct back down again, all sectors were impacted. So multifamily, industrials, offices contributed in equal measure during that initial period of correction at the back end of last year. But now that downside is very much just focused on the office sector. Multifamily, their returns negatives, they're holding things back a little bit in the Odyssey, but it's mainly about the office sector. Retails, industrials are pretty muted. They're all around that 0% return mark. I mean, industrials actually just fractionally positive last quarter. So what does this all mean for portfolio performances? So this is where we kind of start to kind of think through the attribution analysis that we generally present back to the clients. When you break portfolio returns down in a very simplistic way in terms of how much their variance in performance against the Odyssey is allocation or property specific, the long run average, and I think we put this up last course, is about a 70-30 divide. So what that means is on average, 30% of a portfolio's variance against the Odyssey is down to how much they're invested into the sectors. 70% is how they perform within the sectors. And remember, this analysis is just presented at sector level. The allocation element did get as high as 50%, in that growth period, which is pretty staggering for a group of portfolios that are balanced across sectors by definition. But if you think through it, back then that kind of funds with higher industrial or apartment weightings and less office and retail, that could really make a difference to their performance. If you think of how that kind of growth was playing out there with the dominance of the industrials and the multi-family there, and then as returns kind of closed in across the sectors and everything kind of contributed to that contraction, that allocation element starts to kind of drop away. But even now, with that increased divergence across the sectors, we're not seeing more of that allocation tilt. And that actually surprised me when we first ran these numbers for this quarter. But then what you've got to remember within that is that with the exception of the offices, there's actually not a great deal to choose between the other sectors. So the non-office, which is effectively 80% of the Odyssey, is pretty tightly clustered. So allocation strategy within the rest is not hugely impactful, and everyone has a little bit of that problem child, the office sector, within their portfolio. This also kind of underplays the allocation effects as well, because a lot of the variance comes from where funds are allocated within sectors as well. So there's a lot more variance actually within sectors across geographies than there is between sectors. So kind of embedded in that selection bar are the allocation strategies within the sectors. And this is the kind of analysis we take forward to all of our clients on a one-to-one basis. But kind of digressed a little bit there. So let's just get back to the actual performance numbers. So here we're unpacking those in terms of their income return elements. We put them into an historical context. Before we get into the swings of the appreciation, point to note on the green bars is the gradual rise in that income return up to 1%. This is by definition income over value. So as the capital base has declined, the return on income has effectively risen. NOI levels have also been in the ascendancy, a bit less so in recent quarters. But from an appreciation standpoint, that's the red bars. This really illustrates the extent to which the market has turned on its head. We've had 4 quarters of value write-downs. The largest period of correction was clearly Q4 at the back end of last year. But then we've endured an ongoing period of write-downs through the first half of this year. Q2 was pretty much a continuation of Q1 in that regard, so no real let up. And in all, we've seen calculated here just over 11% taken off values over the last 12 months. But this period of correction did obviously come off the back of all that phenomenal growth period. Prior, 7 consecutive quarters of rising values, during which returns surpassed record levels. So if we use the onset of the pandemic still as a strategic marker, values are still just a little over 6% ahead of where they were pre-COVID. But again, there are very different circumstances that have been played out across the sectors. So if you look at those numbers, 14 quarters, 12 months, kind of visually, and break that down across the sector. So the current period of correction is last 12 months, the sandbar, the pre-COVID, the kind of 3.5 years, 14 quarters is the purple bar. Just throwing out some numbers. Office values down around 25% over a 3.5 year time period. Most of that decline, see from the sandbar, coming through in the recent period of correction in the last 12 months. Retail values down 16%, but only a small part of that is more recent. Most of that decline was at the start of COVID. Industrial values, and we know it's strong, staggering 60% up in absolute terms over a 3.5 year time period. So the reductions there are pretty much a minor blip on that kind of 3.5 year context. And again, what this is just showing is that kind of polarization that's been out in the marketplace over the last 3.5 years. That's an 85% swing from the industrials down to the declines in the office sector. So think of portfolio structure on a 3-year basis, and they will be of critical importance. Return to that prior chart. Where it gets interesting is then when we look at the makeup of the appreciation return and how that kind of reversal has been played out. So we can unravel that with Altus with our extensive valuation data set. So how much of the value change we're trying to work through is a product of really the pure economic fundamentals versus what might be termed the investor sentiment or the capital market side. So we first and we've done this before, so hopefully people getting familiar. We try take the red bars, they become the red line. We bifurcate that appreciation, what's termed the yield versus the cash flow drivers. So the yield effect is how much movement in value has been dictated by change in actual valuation yield. So the change in your discount rates and change in the exit caps responding to that increased costs of capital. And the cash flow is the impact on value from the change in the forward projected cash flows that are effectively being priced. So what we're seeing, if you look to the right-hand side of this, is the makeup of that value decline in Q2 at aggregate level is pretty much a carbon copy of what we're seeing in Q1. Those yield increases, which are denoted in terms of the impact by the yellow bars, continue to pull back on value. I assume as the market continues to adjust to higher to longer interest rate environment. I assume that comes as no surprise to you, Robbie.
Yeah, I mean, we all know there's kind of 11 Fed fund raises, right? So in this economy cycle, right? So, and potentially more, right? So, and recently as well, we saw the Fitch downgrade the U.S. credit rating. Granted, it's not that much impact so far, right? So on the 10-year Treasury. But regardless, all of this is present kind of a market with our liquidity issue, right? So, and financing have been tough with higher interest rates, especially in office, right? So investor hate uncertainty, right? So, and therefore we kind of continue seeing kind of yield increases. I think there's one question kind of tied to this as well. So one question come out is basically, what is our thought on significant amount of upcoming multifamily debt maturity, right? So I think that's provide a challenge, but as you can see, as we discuss later on as well, we can see in a sense overall on the multifamily side, but overall, all of that is basically debt maturity coming out. That's going to be a challenge, and that's why you see this yield effect, the cap rate kind of moving up, right, as transactions coming online. So,
sure, and it's coincided with a somewhat fallow period when it comes to the cash flow side of the equation. So cash flows, which have blue bars, that should tend to tick up quarter on quarter and contribute to valuation growth or valuation change. And we're, I mean, the real kind of nebulous behind the growth period there, and more recently actually provides some protection against those increase in rate rises. Have now effectively come to a standstill, and that rather, let's call it muted cash flow outlook, I expect is reflective of the general kind of uncertainty around the whole economic backdrop. But again, this is an aggregate set of numbers, so there are different sets of circumstances that are being played out across different sectors. It's definitely not a one size fits all. So let's roll around the sectors. Let's start with industrials, top right hand side first there, which obviously have been in a league of their own growth wise. The beneficiary of record rental escalation that's been picked up by those blue bars. They've now been going through that period of kind of price correction, but they look to be coming out the other side. The level of pricing adjustment, these yellow bars, does look to be easing up, and with still relatively robust kind of grounding in economic fundamentals, as I said, and they're benefiting from that steady increase in cash flows, which is starting to help stabilize values in that sector. Flip to the left of that, apartments, similar trajectory, rate adjustment rise when compared with industrials, but without that cash flow buffer. So here revenues look to be coming to a bit of a lull, a bit of a standstill. Maybe there's the questions around the affordability being factored in there, plus maybe increase in operating expenses. Bottom right, retail's all pretty muted by comparison. I mean, I would generally summarize this sector as holding its own without seeing a great deal of improvement. If consumer confidence is picking up, and my resident economist, Omar, tells me that consumer confidence has picked up, but it's still apparently 1.5 standard deviations below a 20-year average. So there's still some fragile element to consumer confidence in the current fiscal and economic environment, and we're not seeing kind of huge movements in terms of those cash flows, but they're holding steady. And then across to the offices, you have a totally different set of circumstances there. This is a sector that's clearly in the lens, having suffered a massive wake-up call from the pandemic in terms of the changing working practices. And in the current economic climate, the sector's also been challenged by kind of some scaling back of business activities, and this is collectively putting kind of downward pressure on those blue bars as cash flows. Add in the fact that rate rises have also stepped up in offers in the order of magnitude between last quarter and this quarter, and there's nearly about 9% written off values last quarter. Quickly substitute out the industrials for other in the top right hand side. They look to be kind of also coming through that kind of period of pricing correction. Cash flows here are also stalled, but there's a mixed set of influences here. Storage, I think the cash flows are still ticking up, whereas like healthcare, single family rental are slightly less resilient. I just want to delve a little bit more into these yield and cash flow variances. So here we're ranking the sectors. This is just for the movements in Q2, the appreciation, so the value declines hierarchy there. How much is yield versus cash flow? So you can see from the orange bars that kind of yield, that value reduction was all about, and the root cause was really in that yield adjustment. And that yield adjustment does actually kind of differentiate some of the hierarchy. The two ends of the market though being separated out because of the cash flow gains on the industrials versus the contraction on the offices. But whatever way you look at it, pricing is having the largest bearing on values. And so maybe just want to open up that one first, Robbie. So here we got some actual yield numbers and how much they've moved. So do you want to comment on those?
Yeah, as you can see in here, right? So on the yield effect, definitely if you look at it, it's about the same or slightly better than previous quarter, except for office, right? So office continued to see adjustment higher because uncertainty there, which we'll discuss further more like on the office sector later on, right? So on industrial apartment, you can see that's definitely improvement, right? So basically part of it is increased investor demand, right? So if you look at it in industrial transaction in 2Q 2023, we also reported 122 billion, which is actually more than the average of 2Q for the 5 year prior to pandemic, right? So that showed the strength and investor demand in that sector there. So apartment, yes, there's definitely less transaction compared to pre-pandemic, but part of it is due to the like M&A type deal, like in that sector. So on the other hand, there's a lot of negative news on kind of apartment sector with kind of upcoming multifamily debt maturity and stuff, right? So on the other hand, we saw a lot of our clients put asset on the market. There's record number of CAs, right? So a lot of like confidential agreements signed for a lot of the deal being put on the market, right? So, and if the deal closed, many of them come with significant number of kind of like a bidder as well. Like a lot of them are more than 30 bidders, right? So there's one thing interesting as well, that in the past few quarters, we see an increase of institutional buyer coming in as well. So previously, if you look at last year, a lot of them are non-institutional. Now we see a lot more institutional buyer coming in as well. So I don't see an issue in terms of a transaction side, right? So there's definitely interest on both industrial and apartment. So we're definitely also seeing kind of more stabilization on pricing in that two sector. Compared to office, I think it's still trying to find its footing there.
Yeah, so office is definitely still the outlier in that respect. Just turn to the next slide. We look at the cash flow side of the equation, which has come to a standstill overall. Here we relay the cash flow to 6 key appraisal metrics. The bars show the percent change on those metrics over the quarter. We've explained before that this is there's no scientific approach to this. You can't sum up those bars to come to the cash flow effect, but the color coding gives you an indication whether having a positive or negative impact on those cash flow trajectories. Again, a mixed set of results within the sectors and some trade-offs. So first off, occupancy levels down, retail's the worst affected there. Contract rent, market rent, still moving in the right direction, with the exception of offices, which are just into the red there. For apartments, if you think of those market rent gains, where they have been, and they've been pretty minimal, they've been paid back by those reductions in those forward projected growth rates. It's really only the industrials that have seen any meaningful impact or any meaningful movement in market rents. And while growth rates are still being tempered back there's still a net positive trade-off in terms of the cash flows. You see the reverse of that there with the offices, where no movement in market rent and scaling back of those growth rates. Actually, if you open up those growth rates in a year 1, year 2, and year 3 basis, you see down there with the offices, those growth rates for offices in year 1 have been scaled back by a whole percentage points in the space of the last quarter. That will have had an impact. Added downward pressure for offices can be traced to a mix of rent concessions continuing, an increase in operating expenses. We're picking that up in this year 1 operating expense ratio. So just to remind folks, that's the ratio of projected operating expense as a percentage of gross revenue and how much that's altered over the quarter, that cost to revenue carry, which is increasing for offices. And crucially, when it comes to offices, it's this bar on the right-hand side, this capital expense. So you need to throw in the mix the amount of additional capital that's being required for investment for those office assets to ensure that they, let's call it, remain fit for purpose or competitive in the wider real estate landscape, which is putting further downward pressure on those cash flows, Whether there's going to be a return on that increased capital investment is something, I guess, that we'll be keeping a close watch on. Well, what's your general read in those kind of fundamentals there, Robbie?
Yeah, when you look at it, it's generally flat except for the other side, like industrial and office going the opposite direction. So, I mean, if you look at it like industrial, I always say just wow, right? So every quarter we talk about how industrials like market rent continue to go up, right? So that's kind of what happened now. It's kind of continue to plow along, right? So office is kind of go, we'll discuss more. It's going to go the opposite direction, like so lower occupancy. So now in the assumption side, you need more TI, more capital, right? So longer lease up, higher vacancy, generally all negative throughout in office sector. So it's, again, I think the tale of two city, right? So one's good, one bad, basically.
Yeah, everyone else is hugging the middle ground. So actually, and thinking of time, we might skip this one. It'll be in the deck when everybody gets the information sent out. So this is just a percentage of change in values quarter over quarter. Just thinking of time. And then maybe to the point you just made there, Robbie, just want to pick up on this polling question and we can get the detail of the sectors.
Yep, so this will be the first poll, right? So which sector will hold up the best over the next 6 months? Multifamily, industrial, storage, retail, or office, right? So I'll give about 10 to 30 seconds. So Phil, what do you think? Industrial again? That's easy answer, I guess.
Yeah, I mean, everything's pretty tightly clustered, isn't it, at the moment? And that's the thing. So, but as you just articulated, and we both did, the industrials are the ones that seeing the upside on the rental. So if that continues and they continue to run ahead, then I wouldn't be surprised if that comes through as the biggest bidder.
Let's see the answer. There you go. Answer is 61% industrial. So yeah, as we expected, right? So
okay, well, it's not totally all in the same camp.
Yep.
Okay, right. Well, let's get into the detail within the sector. So back to return levels and really how they've shaken out across the major metro markets. And we've ordered those from west to east. And apologies, there's way too many numbers on this table, and way too many colors. These are the kind of breakdowns that we go into when we run the attribution at a sector level for the clients that we work with. We'll go into the detail of each of the sectors, but I just wanted to introduce some of the formatting here and some major trends. So that top table, that's your ODCE return for stabilized at -2%. Now, then we're color coding everything kind of north or south of that. So in terms of the green, what's having an accretive impact on the ODCE, red, what's pulling it down. And if you compare the Q2 results to Q1, it really does illustrate just how increasingly one-sided on the downside the market has become. You've got that swathe of red running through the middle of that top chart there, and the rest, that's the office, and the rest is predominantly in green. There are a few kind of market-specific outliers as well on the reds. San Francisco, in particular, we want to zero in on. The bottom table is then just the difference between Q2 and Q1. So it kind of plays out that point about the increased divergence that's playing out there, because the more greens on the apartments and industrial, so returns there kind of easing off, whereas the office is kind of dropping away, becoming worse off. Retail's also losing a little bit of ground.
Hold on there, Phil. You said San Francisco red, right? So yeah. Is San Francisco the new Chicago, right? If you look at my prior webinar, I always talk about Chicago is always at the bottom in every property type, right? So it seems like San Francisco is now taking over. Or maybe I should call Chicago the new Silicon Lake, right? So cannot use Valley here because I don't think there's Valley in Chicago, but wishful thinking, being hometown in Chicago here, right? So definitely interesting to see what will happen in the near term. But yeah, that's why I said stay tuned to our next quarterly webinar, right? So that's what we're going to talk about it. Our shameless plug, I guess.
Excellent. Good on you, Robbie, there. And actually, that point on that West Coast piece there. I mean, actually, if you switch up the color coding, so the next slide changes the color coding. So now the numbers are the same, but the color coding is relative to their respective sector averages. So you start to see a lot more of that red shade emerge around those West Coast markets that are coming in below their respective sector averages. And this is the kind of format we want to take forward as we look at the performance trends within the sector. So let's knock out that middle table and look at just the Q2 numbers and then the variant with Q1. I'll start with the apartments. Looking below here, the fact that the returns are generally improving for most markets. The levels of return then up top, color coded in respect to that minus 1.2% for the sector. So we're observing that west-east tilt coming through in the results. Of note on the upside, New York and Chicago, those starting to settle down, returns no longer negative in those markets. This is the return for the quarter. If you then look at the appreciation element of the return for the quarter and then break that down into the yield and the cash flow influences, first off on the left-hand side, appreciation negative across the board. And it's primarily those yield increases that are reducing values. Do have some variances they have been played out in the level of that kind of yield offset, but the mix up in the order also relates through to this cash flow effect side of the equation. So markets that held out better are being afforded some protection from improvements in cash flow levels. And up top, some of those growth rates have started to ease and they've actually started to come back. And so we're seeing the kind of market rents that are coming through started to help support the values at the top end of the hierarchy there. A market definitely worth calling out, I think, in that regard is New York in terms of market rents and those growth rates starting to trend back up. So that definitely feels like a market heading the right direction. Whereas if you go down to the lower end, those growth rates continue to be scaled back and those market rent gains are a lot less so. So the cash flows are offering up little or no protection against those rate rises. So some interesting themes there, Robbie, but I think good to get your thoughts on that, kind of definitely the challenges on the West Coast market, but maybe also the little bit more optimism that we're starting to see coming through in New York and Chicago as well.
Yeah, it is, as you indicated, the bifurcation East Coast, West Coast is pretty obvious, right? So I think with the tech boom in 2020, 2021, the West Coast market are seeing significant increases in apartment kind of new construction with the supply side, right? So now with the tech slowdown, this market are facing the supply challenges, right? So coupled with the economy slowdown there. So that's why we're seeing the weakness in the West Coast market. I think two market I like, as you indicate, I like to talk about is Chicago, New York. Who would have thought Chicago to be the top of the order, right? So like in all the webinar we started, I never talked about Chicago being the top here, right? So that's definitely an interesting phenomenon here, right? So I mean, we all keep hearing the decline in population in Chicago, but using our Altus market insight premium, so we're able to see actually the last 3 months, there's a net flow people to Chicago have become positive, right? So after negative net flow during the duration of pandemic. So the other thing as well that we noted as we kind of seen the growth in absolute number of renter household and also a strong labor growth basically in Chicago. That's even greater than the average city in the United States, right? So furthermore, the downtown core as well, we've been seeing the increase in population, right? So people actually from suburb moving to the downtown core with the traffic and back to the office. So that's kind of what contributing the growth in Chicago, right? So and New York, similar story, it's kind of net migration as well, right? So from January to June of 2023, the total flow of people to New York market area is positive 23,000, right? So that compared to the last 2 years of negative 28,000. So the way I look at it, these two markets definitely seeing a year-over-year kind of basically the population net flow increases, and therefore we're seeing year-over-year rent increases with a positive cash flow effect, right? So we're able to analyze this thing with kind of an Altus market insights. So if anyone interested to know more, definitely reach out to us, right? So we can definitely connect you to the right individual as well.
Yeah, great additional detail there, Robbie. Yeah, so we've definitely seen a bit of shake up in the order for the quarter. If she just, we might skip this next slide just quickly, but just mention something briefly on it for the year. I mean, when you look at it for the year, you start seeing little bit more of that power shift, the kind of Sunbelt versus the gateway markets. And just for the year, the variance is really on the cash flows. If you look at some of those Sunbelt markets, the market rent gains they've been achieving, Dallas and Miami versus the more muted market rent growth at the bottom end of the stack there. It's just worth kind of reminding ourselves that there is that interplay still out there on a 1 year basis. Let's go to the industrials. You see from the lower table the difference between Q1 and Q2. As with the multifamily returns, they're kind of better off in Q2 than they were in Q1 in pretty much all of those metro markets with the industrials. Looking at the top in terms of the markets at the upper end, you've got Miami, you've got Atlanta, we've got DC. You look down the lower end and some of those West Coast markets, San Francisco, LA in the Denver, which had been those phenomenal growth markets we were talking about, almost, it does feel like only a year ago. Denver's also kind of a bit more challenged. It does feel to me that there are different kind of industrial markets on different trajectories. So I kind of wanted to zero in on a selection of those just to kind of explore that a little bit further. So selected 4 key markets in terms of how the appreciation levels have been playing out. Start there with the top left, Inland Empire, so Southern California markets. We're on that phenomenal growth run kind of post-pandemic. I mean, they've almost kind of maxed out in terms of their rental gains, and so that's why that's kind of just eased off, but off the back of that amazing growth run. So that's where that kind of finds itself at the lower end of the rankings now. Go across Denver, lower end of the rankings for a different reason. We talked about this actually last quarter, didn't we, Robbie? It struggled with that more so with the excess supply. I think it had one of the higher vacancy rates, and that's put some downward pressure on rents. Then you go to the other end, the Miami, which looks to be on the rise, and yes, it didn't hit the same heights as those Southern California markets then, but it certainly looks as if rents have got further to run, and that also might be the case for Atlanta. So when I looked at this, it felt as if there definitely is a one-size-fits-all, that there are markets on the industrial side on different return trajectories. Your thoughts on this, Robbie?
Yeah, on overall, whether it's different return trajectory or not, right? What stand out to me is, irrespective of the market, the fundamental agenda is still positive here, right? So right, positive cash flow effect, right? So majority of come from higher market rent, right? So expenses are not too much impact on this sector because most leases are triple net anyway, right? So, but yeah, the Sun Belt are strong, right? So, and overall, I think that the positive cash flow effect that's carrying kind of the industrial market, and less yield effect kind of quarter to quarter.
Okay, thanks, Robbie. Right, well, let's turn to the office market. If I can move my slides on. The bottom table, in terms of the difference between Q1, shows most markets experienced larger performance setbacks in Q2 than they did in Q1, so different from the multifamily and the industrial in that respect. In terms of the color coding up top, relative to that sector average of minus 7.3%, worst affected, Seattle, San Francisco, Chicago, also New York. It's mainly the Sunbelt markets, metros, your Dallases, your Miamis, your Atlantas that are offering up a little bit more resilience in the green. You've also got quite a number of those kind of Sunbelt markets caught up in that other grouping, also coded up there in green. If you break the return variances down, then into their yield and cash flow influences, markets down the bottom end are just kind of called out. They're seeing the larger yield adjustments. They're also scaling back more of like on the cash flow side. Yes, growth rates are down across the board, but if you're looking down the lower end at San Francisco, Seattle, those market rents have actually come down in the last quarter. And then you have that increased capital that needs to be invested, and that's putting added downward pressure on value. You can certainly see that in Chicago and in New York. That's the one quarter. If you turn to the 1 year and you think of the market in terms of haves versus have-nots, the haves more Sunbelt, the have-nots the gateway markets. They're very much separated really when you just look at this metric here in terms of the market rent changes. So markets, the Sunbelt market, office markets, which call them more fully utilized, have been able to kind of increase market rents, whereas lower down, those kind of gateway metros, those market rents have actually started to come down over the course of last year. So, Robert, your thoughts on some of the main themes, but also I know that we've obviously run some additional analysis as well that you can share with the audience today.
Yeah, no, there's one thing that if you look at the West Coast market, they've been holding up previously, right? So if you look at last year, they've been holding up. But who would have thought Seattle actually catch all the way down to the bottom, right? So it's basically like a Seattle, San Francisco that's catching up, because previously we talked about New York, Chicago, Washington being at the bottom, right? So the West Coast is definitely moving down. Part of it is basically with more negative cash flow yield effect, right? So in the market rent continue to decline in those markets as well, right? So and then as you indicated, there's have and have not. Right, so yes, there's geographical differences, but we also noted that WALT and occupancy do matter, right? So therefore we're running more analysis on it. So on our Odyssey clients, so we cannot run on all Odyssey clients. If you look at the next chart, what we did is trying to break out basically offices into different categories, right? So one, we're stripping out the life science and medical office within Altus Odyssey client, right? So and then breaking the remaining traditional office into different risk bucket, right? So low, medium, and high. So low risk generally is high occupancy, low WALT, right? So high risk is occupancy less than 70%, or some a little bit higher occupancy but short WALT, right? So therefore you can start plotting them up as well. So and take all the fund, put in a grouping, right? So into bucket, right? So basically each bucket about 3 to 4 fund out there. So one thing to note, if you look at it, the fund with the higher return and the fund with the lower return, a lot of them are correlated to basically the composition of it, right? So the more life science, medical office, and low risk, the better the return is. But the more red bar, on the other hand, the lower the return is, right? So, and the next slide is basically now we just purely taking out on just removing life science and medical office. Right? Same situation, right? So that the red bar is a big composition of it. So the bigger the red bar, the lower the return, right? So, and the next slide as well, what we're doing it is now taking the same thing and using a CBSA, right? So the trend is still similar, right? So i.e. the more red bar, the more high risk asset in that CBSA, they definitely have kind of the lower return. Of course, there's differences associated to region, but overall it is still kind of correlated to the high risk and low risk assets. So.
Okay, yeah, no. I know there's been a lot of interest in this. We've presented this at a couple of industry events recently, and obviously once we talk to our clients over the next few weeks, we'll be kind of positioning their portfolios against these metrics as well, clearly on a confidential basis. But yeah, I think this really does get to the bottom of some of those return variances that we are seeing across portfolios and seeing across those metros. So thanks for sharing that, Robbie. Let's finish off with the retails. A bit more of a mixed set of results, I think, than I was expecting. This is just for the quarter in terms of that appreciation, the fact that neighborhood centers, some of those grocery anchored, are at the foot of the rankings alongside super regional malls, maybe proves that the retails aren't quite out of the woods just yet. Value decline though is very much around that kind of that yield increase. I mean, cash flows, yeah, they are generally on the rise. I mean, static down here, but so maybe they're containing and spending, but the cash flows are holding out. The variances is more on the pricing side. I mean, Robbie, your thoughts and your read and what you've heard about the retail sector. Do you want to share that?
Yeah, it's generally uneventful, right, for the past few quarters already, right? So generally you see the positive cash flow, right? So they're not really sunny, not really rainy either, right? So there's pricing adjustment. I think that's much more property specific. And typically if there's any specific occupancy issue here and there, tenant not renewing, there's impact on certain asset, right? So I don't think anything in a broad brush basis, but generally positive on cash flow and adjustment more on the individual asset basis.
Okay, and actually just look at things on a 3-year basis, just to wrap up on the retails, then I mean, no surprise to folks that the more resilience is on those neighborhood and community centers at the top end of the ranking, whereas the grocery anchored where the malls are down below, and they're the ones that have really borne the brunt of borne the brunt of that price discovery with those larger rate rises. And I think that pretty much gets us to the end of the material that we wanted to share. So hopefully that was all helpful to be stepped through that, as they will be talking to our clients around this on a one-to-one basis. So do get in contact if there's anything that sees your attention around this. But just a final polling question, Robbie. I think there might be stuff in the chat box as well.
This is the last poll, right? So as I said, power the many. So we need as much input from all you guys, right? So basically, again, I think that the whole thing is, what is the total unleveraged property return in 3Q 2023, right? So it was 1.9% in 2Q, right? So basically, 1A is 1 to 2%, i.e. positive value movement. Second is between -2 to +1, so i.e. appreciation between -0 to -3, or -4 to -2, like so basically appreciation between -3 and 5, or significantly more negative, i.e. below 5%. So I give about 5 to 10%, 5 to 10 seconds, maybe, hopefully, like so I know we've been up for a while, so then we can see kind of the return. But yeah, please join to the power of the many, right? So let's predict what the return will be next quarter. What do you think, Phil? Here you go. I guess is the second one, so it's very similar to last quarter prediction.
Yeah, also no surprises there. Okay. Anything in the chat there, Robbie? I think we've got a few minutes left.
Yep. So basically, I think there's one question: is the negative market rent growth in year 1 and 3, is it the direct result of the increases in the amount of supply? First, I don't think is, if you go back to the chart that with the 3-year kind of market rent growth slide, Phil, I don't think it's kind of, it's not a negative growth, it's the decline. That negative rent growth is the decline from previous quarter, quarter, right?
So that office, I don't know, we can share the actual numbers off the back of that, and we can actually put the numbers on this. It might have gone down from a kind of expected growth rate of 1.5% down to 0.5%. So that's what we're picking up there. So there's still some expected growth, but it's 1% less than it was in the prior quarter. So that's the way to read that. And likewise, this is a change in the 10-year average, which obviously there's years 4, 5 to 10 out there as well.
Yeah. So that decline, part of it, yes, the supply. So and as the supply going in, that's for sure people kind of reduce the rent growth, especially in the near term. And second is uncertainty, right? So second is uncertainty, and third one for industrial, as market rent continue to go up, at some point you cannot go at the same pace anymore, right? So that that 3 component kind of result in that reduction on the market rent growth.
Yeah, if we put the numbers up there, I mean, those industrial numbers, which in year 1 would have been around the 5% mark, coming down. So they're still strong. I don't know if they're at 5 now, but yeah, they're coming down off high levels.
Yep. And then the other question is, what happened to Boston apartment, right? So what driving the decrease in Boston? So I would say that's associated to pricing adjustment, right? So if you look at it, the cash flow are relatively still positive, but as cap rates start moving up, and that's what driving kind of the Boston adjustment. So next question is basically, could you clarify the low risk and medium risk office CBAC risk breakdown? So the way we're taking it is basically, like there's a lot of we're trying to remove subjectivity from kind of an office ranking, right? So what we did is purely based on WALT and occupancy. So if it's an asset more than 95% occupancy, the WALT more than 7 years, we categorize in a low risk, right? So in every asset that's kind of lower than 70% occupancy, or 70 to 85 with a very short wall in basically what I call it like a trouble market, right? So that's typically high risk, and everything else under medium risk, right? So that's kind of pretty much what bucketed on that basis. Next question: is data on historical quarterly gross valuation changed by quarter and market available? I think it's from NCREIF is available, right, Phil?
The change on prior quarters?
Yes.
Yes, I don't know if I really understand that question.
Yes.
Sorry.
Basically, again, I think it's historical quarterly gross and net appreciation return broken up by sector and market available.
Yeah.
And let me see some more.
If whoever's asking some of those questions, they can ping directly through to myself, my colleague, Mike Camthor, and we can try and share what we've got.
Yeah, and then the question is as well on office, why so little change in market rent for office? I think that if you look at just face rent alone, it may not be that many changes, but there's a lot of changes in the net rent side, right? So basically, I think that the way that a lot of the office leases are done as well right now is basically giving more TI, free rent, right? So all that thing is basically impacting more on the net rent. In here, we just kind of purely capture the face rate perspective. Okay, let me see. There's a lot of question coming in. I think there's a lot of question, I think, on the banding as well, right? So, do you have 1 year performance on data on the sold asset compared to overall index?
The sold assets, don't have them here. We can reverse engineer that. I'm talking on my feet here, but we can only do that for the 24, the 23 now, the 25 Odysseys, but we could look at that, and we have actually done that as an exercise for a couple of clients previous in the past to see kind of where the movement is on sale.
Yeah, and it's a tricky one as well, right? Because some asset, like basically, again, a lot of the sold assets are non-strategic asset, even historical perspective, right? So comparing sold asset to an overall index number may skew it as well, because again, it tends to be sold some asset that either make more liquid or there's something that's not strategic anymore. So then you compare it to kind of the blended number, so it can get tricky there.
Yeah, and sometimes we see some of the value correction come through in the prior quarter as well. So.
During the period of growth in 2021, did the cash flow effect hold strong in other sector besides industrial?
Yeah, so that growth period, it held strong for both multifamily as well as for industrial. So yeah, we didn't see any great change, and we saw some improvement. I mean, think about the after the pandemic, there was definitely a kind of a retail pickup in terms of spending. I mean, those bars are small by comparison, but yeah, the record rental kind of levels being set were on the industrial, but also coming through on the multifamily side, and storage within that was generally doing what, not to the same order of magnitude as the industrials, if that's the question.
Yeah. I think this question, I think people asked before as well, I think during the individual. So on traditional office risk metrics, can you comment on performance on Denver? That seemed to be an outlier. Should be expecting further negative. So again, I think the Denver market is a smaller market, smaller office market as one, right? So, and when we kind of trying to break that down just purely based on asset and at that point in time. So, and I know that Denver is basically have some transaction that happen as well, right? So that transaction may be better than the decline expected. So you're only looking at that one spot, but the return including over the last 3 years, right? So that's kind of part of that equation of the Denver on the breakdown on the risk perspective. So, and plus the development asset, you get development asset within certain market as well as the small market, the development profit could be embedded into the appreciation piece as well. So therefore, when you look at just one specific market, especially smaller market, it might appear an outlier. Okay. Will data center be broken up in the future from the other?
I can answer that one. So data center, once NCREIF have finished off their reclassification exercise, they will be categorized, I think I'm right in saying, under industrials. And a lot of the data centers currently are being picked up and within that industrial number. But there are some in other still. Goes back to your question earlier on, Robbie. But once they've all been recategorized under industrials, then the plan is that NCREIF will then be able to separate out and provide an actual data center return number.
Perfect. Yeah, I think that we are at the bottom of the hour. We're at 1 o'clock Central now, right? So we respect everyone's time. So pass back to you, Phil. Closing comment.
Yeah, no, thank you very much, Robbie. Thanks everyone, especially for dialing in. We appreciate your interest in this. We very much look forward to the next few weeks to talk to our clients on a one-to-one basis on this. If you've got questions, send them through, get in contact with your client lead. But thank you very much for listening to us and talking through that with us. And we'll get the date out for the next webinar shortly, so in the early part of November. But thanks very much. Enjoy the rest of the day, everyone.
Thanks all.